All right, so CPI described, at least by Waller, mildly disappointing. I think it was a shock to a lot of other people. We saw bond yields spike a bit. Then PPI was just okay. Coming up this week, actually tomorrow, we get those Fed minutes. How do you see the market reacting, and how does that potentially impact your thesis that we're actually more likely to see 2 to 3 cuts this year than a hike, as some people have been putting out there?
Yeah, I think my primary, thought around that is the biggest weight in the CPI basket is rents and shelter, right? It's not talked about nearly as much as tariffs or energy or some of the things that drive some of the month-to-month volatility, but we see this slow downward pressure on rents and shelter. And I think that means by, the mid to the back half of the year, the core inflation picture and core PCE picture, which the Fed cares a lot about, will look good enough for them to cut 1 or 2, potentially even 3 more times, especially if we have more data like retail sales we saw last week. So, the Fed is worried about the recent pop in inflation. They're thinking about tariffs, but I think the picture is just fine, and I think they'll be able to resume cutting in the back half of the year.
All right, so you see, again, those cuts coming in the back half of the year. I want to talk about what's going on right now, specifically last week in the markets. We saw tech regain leadership. Tech was the best performing sector last week. What does that say to you? As a lot of people are wringing their hands about frothiness in the market and these elevated valuations, the fact that a lot of these stocks that have these elevated valuations have retook leadership, at least for last week.
Yeah, I mean, if you're worried about valuation, this has been a tough market for not just the last couple of years, but the last decade, really. I'm happy to see the cyclical leadership and the big names at the top of the market reassume some leadership. We're seeing other corners of the market work. Things like financials have worked. Things like discretionary, has largely worked. Some sub-industries, some cyclical sub-industries that have worked. So it's not a monolithic market that's just focused on big tech, a very narrow market like we saw in 2023. So as long as big tech is leadership and there's things working underneath the surface, that's fine by me. I'm glad to see the big names working. Enough people are invested in cap-weighted indexes that if those names aren't working, people don't feel the breadth of the gains in the market.
One thing I want to talk to you about is tariffs. So, again, we heard Waller kind of downplay tariffs. That's only going to lead to modest price increases. But I think a lot of other parts of the market have become very concerned about tariffs. We were showing a board earlier in the show. The indices tracking some of the countries in active tariff discussions, trading lower this morning, but with the exception of the INDA, all higher over the last week. In your mind, when investors are looking at the U.S. markets and also foreign markets, how do they play a part? I mean, are tariffs a sign, like a kind of a yellow light, maybe you should slow down? Is it a green light with the idea that the worst is already priced in, or do you think there could be more pain ahead due specifically to tariffs, just to be clear?
Yeah, I think it's obviously the number one question that we're being asked by clients. I think the number one question facing the markets is, what are the extent of the tariffs? When do they go into place and on who? I think the market's lesson so far has been that most countries are open for negotiation, and that's a positive sign, right? The lessons from Mexico, Canada, Colombia are that if you're willing to negotiate and offer concessions either on the trade picture or on other things that the Trump administration wants, tariffs don't necessarily need to be as punitive as maybe we saw on the campaign trail. So I think it's a yellow light, to use your terminology. I don't think it's a red light. Certainly the lesson from the first Trump term is trade wars and tariffs were not all that inflationary. Inflation remained pretty well anchored through Trump's first term until COVID-19. So, the Fed is taking them into calculus. I'm not sure that fits with their data-driven approach, but I think it's a yellow light for now. Unfortunately, we're just kind of trapped in wait and see mode.